So hi all. So welcome for this session. This financial reporting and the topic is published financial statement. It's under IAS 1. So note that now before I start this session, so these are topics that you need to pay attention because in your financial reporting exams, actually in general as an accountant, this is what they do. Presentation of financial statement. Be it the income statement, be it the statement of financial position, statement of cash flow, statement of changes in equity, all that. Now, under this topic in financial reporting, these are topics that you will never miss in your exam. And it usually carries 20 marks. And then under published financial statement is just a composite of many elements or many topics. Now, for example, make sure before you go through this topic, you have gone through accounting for assets and liability. Because accounting for assets and liability, all those standards is what will now be compiled so as to enable us to prepare the published financial statement. Now, what's published financial statement? Now, under IAS 1, it provides on how do we present the published financial statement. Not just the financial statement, but the published financial statement. And published financial statement, these are a summary or a condensed set of financial statement which is ready for publication. Let me repeat again. It's not just a financial statement. Number one, it's a summarized summary. And then I hope you have your notes. So kindly make sure that you have your notes. Don't make your own notes, because I have prepared the notes for you. You are supposed to be having the notes by the time you're watching this video. Make sure you have the notes. And then everything I'll be explaining, mostly the introductory part, you have them in your notes. And then the illustration will be doing. So you're saying that the published financial statement is a set of summary or a summarized financial statement which is ready for publication. And what are those financial statements? Now, published financial statements are classified into 5. 1, we have what we call the statement of comprehensive income. That's what commonly known as the income statement. But in this case, we call it statement of comprehensive income. Then number 2, we have the statement of financial position. That shows the assets, the liability, the equity. That shows the financial strength of the company. Then number 3, we have what we call the statement of changes in equity. Now, statement of changes in equity is a statement that shows the owners or the shareholders' wealth, be it the ordinary share capital, be it the share premium, retained earning, revaluation reserve, like that. Then that was number 3. Number 4, we have what we call statement of cash flow. Now, statement of cash flow is under IAS 7. We'll come to discuss that one later. I also have done that topic in the other video. That's under cash flows. Then that one was number 4, the statement of cash flow. And then lastly, number 5, we have what we call the note to the above financial statement. What does it comprise? So you're saying that published financial statement, they include statement of comprehensive income. We have the statement of financial position, statement of changes in equity, statement of cash flow. Saying that statement of cash flow, it's not under IAS 1, it's under IAS 7. We'll discuss that one later in as a topic itself. Then we have notes to the above financial statement. So now let me explain what we mean by the notes to the financial statement. Now the notes to the financial statement, it includes the explanation and details of the element included in the other financial statement. Because we are saying that the other financial statement is just a summary. Now, be it summary, how do we show those breakdowns? Now, that breakdown will be shown in the notes to the financial statement. For example, under the notes to the financial statement, it will show what are some of the accounting standards, accounting policy used. Also, it will show some reports. Which are those reports? Reports such as director's report, auditor's report, segment report, compliance report, etc. Also, it will show some breakdown of some items. Now, for example, PPE movement schedule. Yeah, all those items now will be included in the notes to the financial statement. Then, now let's look at what are some of the special topics to memorize. Now, for you to determine or for you to understand on how to prepare those published financial statements, I have prepared for you a summary of some elements which are under asset accounting for asset liability, which you need to memorize. It should be at your fingertips. So kindly listen here carefully because they are very simple. You just need to understand them. Because previously we have already done them under accounting for assets and liability. And number 1 is on recognition of closing stock. How do we recognize closing stock? Now, in the financial statement, when preparing the financial statement, now closing stock should be recognized. That's under IAS 2. Closing stock should be recognized based on the ROA of either ROA of, number one, either the cost or the net realizable value. So if you're given that these are the stock we have at the end of the financial year, and this was the cost, we had bought this stock at this amount, but we have what we call the net realizable value. Now, net realizable value is that if you are to sell these items now, less any transaction cost, how much will you realize? Now, that's what we call the net realizable value. So in case you have the details of the two, you take the row of the two. You recognize the row. Now, for example, assuming you're told that the stock at the end, we had 60 million, that's the cost, and the net realizable value, assume it's 56. So that means when determining the cost of sale or when determining the closing stock to take it to the statement of financial position, you'll take the row of the two. And in this case, the row of the two will be 56 million. That's how we recognize the closing stock. That closing stock should be recognized based on the row of the cost or net realizable value. That's number one. Another special topic you can it's all about recognition of provision. As we had earlier done on provisions, we went through what we call the provision, the contingent assets, contingent liability. Just a quick recap. We see that provision is like a liability of some uncertainty that will happen in the future. Then we discussed about the contingent liability and contingent assets. Now we say that for contingent assets and contingent liability, they are not recognized. They should only be disclosed to the notes to the financial statement. But for the provision, it should be recognized. Now the question is, when do we recognize a provision? Now note that a provision should only be recognized if the probability of occurrence is more than 50%. If the probability of occurrence is not more than 50%, now that one becomes a contingent liability. And a contingent liability are not recognized. They should only be disclosed. So note that provision should only be recognized if only when the probability of occurrence is more than 50%. What do we mean by provision? Now, for example, assuming that your company has been sued, maybe for the breach of contract. Now, in this case, that means there is a pending legal case, which will be determined in the next foreseeable future, or the next financial year, or in some few months. But in this case, you are closing your financial statement. So you need to make a provision of maybe damages. Now, that provision of damages should only be recognized to the financial statement. That's the income statement of the balance sheet, only when the lawyer has advised that the probability of that occurrence that you pay the damages is more than 50%. If the probability of the other party winning is less than 50%, let's assume 30%, you should not make any provision. Rather, you should recognize that one as what we call a contingent liability. So note that provision should only be made if the probability of occurrence is more than 50%. Good. Then we have what we call the financial assets. That's under IFRS 9. Also, this one we discussed under accounting for assets and liability. And if I take you back, we see that under IFRS 9, it provides for what we call the financial instrument, not financial assets. Financial instrument. And what's a financial instrument? Now, financial instrument is a contract which gives rise to an asset to one party and a liability to another party. I repeat again, that financial instrument is a contract which gives rise to an asset to one party and a liability to another party. Now, for example, if I give you a loan, so to me, it becomes an asset. To you, becomes a liability. Now, that's what we call a financial instrument. If, for example, you invest, or for example, if you take your money to the bank, that's what we call cash at the bank. To you, it's an asset. But what about the bank? To the bank, that's not their money, it's your money. So the bank will record a liability. Now, that's what we call a financial instrument. If you buy shares of a company, to you, you have invested. So therefore, those shares is an asset to you. What about the company? To the company, that's why they include equity and liability. Because the money they are operating with is not their money. It belongs to the shareholder. So that's also what we call a financial instrument. So, and then we say that financial instrument, it gives rise to an asset to one party as well as a liability to another party. Now, in this case, now I'm discussing about the financial asset. A financial asset. Therefore, what's a financial asset? Now, a financial asset is a financial investment which gives the holder the right to receive or they expect some future economic benefit. And we said that financial assets are further classified into four. I don't want to mention all the four because I had already done that one earlier. We said that financial asset and IFRS 9, they are classified either as, number one, we have what we call financial asset at fair value, available for sale, loan and receivable, and number four, it's held to maturity. You can consult your note. Those four: financial asset at fair value, available for sale, held to maturity, and loans and receivable. Now, I want to discuss the first two. Number A, financial asset at fair value, and number B, we have the available for sale financial asset, AFS. Now, what's the difference between the two? Now, both of them, they are financial instruments or they are financial assets. But what's the difference? Now, note that financial asset at fair value, they are short-term investment. They are short-term investment. For example, if you buy a treasury bill is a short-term. It matures within 1 year. So that's what we call a financial asset at fair value. Therefore, if they are short-term financial investment, therefore they should be recognized as part of the current asset. Since they are short-term, therefore they should be recognized as a current asset. And then how do we measure and recognize them? Now, financial asset at fair value, they will be recognized and measured at the end of the financial year at fair value. Measured and recognized at fair value. And fair value simply means the market value. So that's financial asset at fair value. We're saying that number one, they are short-term financial investment, and therefore, since they are short-term, therefore as a company, they should recognize them as a current asset. And then how do we measure them? We measure them at fair value or the market value. Then, number two, we have available for sale financial asset. On the other hand, available for sale financial asset. Now, it's just a financial terminology. Don't think that available for sale is something which is ready for sale. No. There's a difference between what we call held for sale and available for sale. Available for sale is just a financial terminology, which this one includes, and we are saying that available for sale, they are long-term financial investment. A long-term investment. Now, for example, if you buy a bond, if you buy a share, now those, or you buy a debenture, invest in a debenture, now that's what we call available for sale. Now, for example, if a company, nowadays most of the company, they are buying share in another company, or they invest in government bond. How will you then recognize that one in the financial statement? Now, under financial statement, you have under non-current asset, PPE, that's property, plant, and equipment. Then, you'll not include government bond, no. If you see available for sale, now that's what they mean. They have invested in long-term financial instrument or just investment. So we are saying that available for sale, they are long-term financial investment. Therefore, if they are long-term, therefore they should be recognized as part of non-current assets. Non-current assets. And then how do we measure and recognize them? So they are measured and recognized based on, or either on, measured at either at fair value or at amortized cost. So available for sale, they are measured and recognized either on, they can use either of the model. One, the fair value or the market value, or number two, at amortized cost. What do you mean by amortized cost? For those who are doing financial management, if you are to amortize something, you come up with amortization schedule. Now, amortized cost means the present value of the future economic benefit. For example, now if you've invested in a debenture or a bond, you expect to be receiving interest at the end of the financial year. Now, those interests, if you rediscount to get the present value, plus upon maturity, you'll get back your money. Also, you rediscount the maturity value. Now, that's what we call amortized cost. In short, it's what we call the present value of the future expected benefits. That's what we call amortized cost. So now note the difference that financial asset at fair value, they are short-term, but available for sale, they are long-term. Therefore, for financial asset, since they are short-term, they should be recognized as a current asset. but the other one will be recognized as a non-current asset. And then how do we measure financial asset at fair value? They are measured and recognized at fair value, but for available for sale, they'll be measured and recognized either at fair value or at amortized cost. And then in your handout, I have provided the hierarchical way of determining the fair value of an element. So in your handout, you go through that, the hierarchy of determining the fair value. So that's our special topic, memorize number 3, financial asset. So number 4, I want also we discuss on deferred tax. Deferred tax we discussed, and that one I have done a video on deferred tax, income taxes, that's under IAS 12. Income taxes, I've done a video on that. So kindly make sure you have gone through that before you go to you come to this topic, income taxes. And what do we mean by deferred tax? We say that deferred tax is a tax payable in the future, which arises as a result of taxable temporary difference. Tax payable in the future, which arises as a result of taxable temporary difference. And we say that deferred tax, it can either be an asset or liability, but in most cases, if it's payable, it's a liability. So therefore, deferred tax, it's an non-current liability because it's not payable, it will be payable in the future. But the current tax, the tax for the year which has not been paid by the end of the year, now that one becomes a current liability. Deferred tax, a non-current liability, current tax, a current liability. Then, how do we measure deferred tax? It can be an expense, can be an income. Now, note that an increase in deferred tax, because deferred tax is just a provision, increase in deferred tax liability, it's an expense. So, increase in deferred tax, it's an expense. Because we are saying that deferred tax is a liability. When liability increases, it becomes an expense. Also, decrease and reduction, decrease in deferred tax liability becomes an income. Yeah, an increase in deferred tax becomes an expense. A reduction in deferred tax becomes an income. And that one will help you in determining the tax expense for the year. How do you determine the tax expense? Now we say that tax expense is recognized, it's made up of 2 elements. One is the current tax, and the current tax is the tax for the year based on the taxable profit. For example, if you made a profit of 3 million, 30% of that 3 million is what you call the current tax, is the tax for the year. Then you also factor in the changes in deferred tax. Not deferred tax, but the changes in deferred tax. Because deferred tax will be recognized as a liability. The changes is what you take it to the income statement. And how to determine the changes? We have said that an increase in deferred tax becomes an expense, therefore increasing the tax liability. So an increase you add. A reduction in deferred tax, on the other hand, we have said that a reduction in deferred tax becomes an income, therefore reducing the tax liability. So you deduct. That's how you determine the tax expense. You're saying that the tax expense is made up of 2 elements. Current tax, and that's the tax for the year. Then changes in deferred tax. And we are saying that an increase in deferred tax becomes an expense. A reduction in deferred tax becomes an income, therefore reducing the tax liability. Good. Now this is what I mean. Assuming the balance brought down at the beginning of the year of the deferred tax was 500. Then at the end, based on the provision, that's the balance carried down, it has increased to 700. Now, this 700, the balance carried down, is what you'll take it to the balance sheet as non-current liability, deferred tax. But the changes, it has changed from, and it has increased from 500 to 700, an increment by 200. Now, that increase, you add it to the tax expense, and that's what you take it to the income statement. In case of a reduction, you reduce. But note that the balance carried down always will be taken to the balance sheet as part of the non-current liability. Good. So that's the deferred tax. Then I have provided some NBs. Number 1 is that Revaluation changes for PPE, that's the plant, property, and equipment, and the available for sale are recognized under other comprehensive income. Yeah, revaluation changes for PPE, that's the one of the non-current assets. Also, available for sale. Remember, we say that available for sale, it's a long term. So therefore, it's part of non-current assets. Also, intangible assets. Now, their revaluation changes, be it a revaluation gain, be it a revaluation loss, they should be recognized as part of other comprehensive income. What do we mean by other comprehensive income? Now, once you prepare your financial statement, and then you get the profit after tax, or the net profit. Below it, that's when you add other comprehensive income. That's where you factor in the revaluation changes, and you're saying that you only show the revaluation changes for PPE, available for sale, and intangible assets. They will be under part of other comprehensive income. In case it's a revaluation loss, you show it as a negative. In case it's a revaluation gain, you show it as a positive. Number 2, revaluation changes for items valued or measured at fair value are recognized under other income. I repeat again, revaluation changes for items or for assets measured at fair value, such as financial asset at fair value, also investment property under IAS 40. Investment property under IAS 40 are measured at fair value. So you're saying that assets measured and recognized at fair value, their revaluation changes should be recognized under other income. Where do we recognize other income? Other income, once you take the sales minus the cost of sale, you'll get the gross profit. Now, below the gross profit, that's when you factor other incomes, such as rental income, investment income, also fair value gain. But in case it was for PPE, available for sale or intangible asset, you see that you recognize under other comprehensive income. Good. NB number 3, ordinary share capital is recognized at par value with any balance recognized under share premium. Now, what do I mean? We are saying that ordinary share capital is recognized at par value with any balance taken to the share premium. How does the share premium arise? So now reason here. How does the share premium arise? In most of the financial statement, you'll see ordinary share capital, and then you'll be given in bracket shillings 10. Now, this 10 shillings means is the par value. This is what I mean. Now, for example, assume you bought 1,000 shares from Safaricom, each at 10 shillings. That was the par value. The par value does not change. 1,000 shares and were issued at par value at 10. So that means your value of the investment, of the equity investment, is 10,000. Assume this was way back in 2010. Then, 2022 or 2023, you still hold the same number of shares, 1,000 shares, but now the market price has changed. The market price is no longer 10. The 10 was the par value. Now, assuming that the market price currently is 50 shillings. So how much is worth of your investment? The equity investment is Safaricom. So that means it's 1,000 times 50. Now your investment is 50,000. Now, how do we recognize this? So what do you take to ordinary share capital? What do you take to the share premium? We have said that ordinary share capital will always recognize at par value. So you will take 1,000 shares, you recognize them at par value, and the par value is 10, and that will be 10,000, with any balance taken to the share premium. You have 1,000 shares, the par value was 10, but the current market price is 50. So that means there is a capital gain. It has gained by how much? From 10 to 50, that difference of 40 is what we call the premium. So 1,000 shares, each at 40, you get 40,000. Now, this is how you recognize. You don't show that the ordinary share capital is 50,000. No. The ordinary share capital, 10,000 at par value. With any balance, you show you have a share premium of 40,000. So that's how you recognize ordinary share capital. Good. Then number 4 is another point to note that remember, you see that published financial statement is a summarized set of financial statement. Being a summary, PPE is recognized as a single element under the statement of financial position. So note that when presenting the PPE under the statement of financial position and a published financial statement, you only show PPE as one item. What does that mean? If the company has land, a building, motor vehicle, also furniture, you see, it's something to be published. You don't expose all the assets you have to the outsiders. So what will happen? You work them as a separate schedule, a PPE movement schedule. You work them as a single element. Now, that single element, the single figure, is what you take it to the statement of financial position as property, plant, and equipment. You don't show separate item, equipment as land, building, no. In this case, for published, I show them as one element, that is PPE. Then, also expenses and the income statement are categorized as follows. So also we say that this one is a summary. So to the income statement, you don't show salaries and wages. You don't show the others. How much was the depreciation? How much was the advertising cost? No. Under the statement of comprehensive income, the expenses will be classified into four. One, it's either the cost of sale, or admin expenses, or selling and distribution expenses, or finance cost, or the interest expense. Now, the expenses should be classified into those four. It's either cost of sale, it's either an admin expenses, distribution expenses, finance cost, or interest expense, those four. Now, in case you have a depreciation, and assuming the examiner is not, or they are not specific, so it's upon you now to use your judgment. Now, for example, if you're given a depreciation of building, so why will you classify it? Now, building will be part of admin expenses. Or, for example, if you're told about depreciation of delivery van is used for distribution, so therefore it will be part of distribution expenses. Assuming there was interest on debenture, say that all interest, they are part of finance costs. Now, what are we comprised by the interest, the finance cost? Finance costs will show the interest expense, number one, on loans, or on redeemable preference shares. Interest on redeemable preference shares. Loss on inventory, that's part of the cost of sale. Carriage inward, part of the cost of sale. Purchases, part of the cost of sale. And you know how to get the cost of sale? It's opening stock plus purchases minus closing stock. Good. Then tax expense is made up of two elements. This one I have explained here, that the tax expense is made up of the current tax and the deferred tax. So kindly, for you to understand this, for what I have explained, you can watch this video again. Actually, for the only part that I have explained. Also, you can use your note. Kindly don't make your own notes, because everything I have explained here, they are already in your notes. Kindly go through them now before we do now an illustration. We do an illustration. So, and I want us to do this illustration. Open with me November 2016, question 2. November 2016, question 2. So now let's do an illustration. November 2016, question 2. November 2016, question 2. And then I can advise you, you can pause the video. You pause the video, you go through the question. Then we do the second reading with you. That means I'll be reading, now you'll be listening. Yeah, so I'm hoping you're there. November 2016, question 2. Yeah, you can pause the video and you read for yourself for like 5 minutes, and then we read it together. So, and we are told this. The following 12 balance was extracted from the books of Peak Limited as at that 1st October 2016. You have rent, a building, we have branch, we have purchases, distribution expenses, admin expenses, loan interest paid, leased plant rentals, inventory, account receivable, long-term investment. We have the revenue, ordinary share capital, 20 par value. Remember, we said that ordinary share capital are always recognized at par value. Also, we have income from investment, retained earnings. We have 8% debentures, dividend paid, account payable, cash in hand, deferred tax, bank overdraft, accumulated depreciation for both the building and the plant. Additional information. So now at additional information, I want us, we adjust one by one. And we are told that number one, the 8% debenture were issued on 1st of January 2016. Interest is payable 6 months in arrears. We read again. The 8% debenture was issued on 1st of January 2016. Now, when is our reporting period? The reporting period, I mean the reporting date is on that 1st October 2016. But the debenture was issued on 1st of January 2016. So that means the debenture has been outstanding for 10 months of that financial year. So, number one, we determine the interest on debenture, which is 8%. Now let's go back to the statement. So you'll take 8%, and how much was the debenture capital? Debenture capital was 300, of which 8% of 300, you'll get 24. Then you are told that interest is payable 6 months in arrears. You see the 8% of 300, the 24, it's for the whole year. So 6 months, divided by 2, that's 12. So can you go back to the trial balance? Just look at the amount of interest paid. How much was the interest paid? The interest paid is 12, which is half of this. But remember the debenture was issued on 1st of January. We are using the accrual basis. The expense incurred, not what was paid. So it's 24, this is for the entire year. 10 over 12, so that you get the interest expense for that period. And you get 20. Now, this 20 is what you take it to the income statement as interest expense. Remember, we use the accrual basis of accounting. What was incurred rather than what was paid. Then, you're already given in the 12 balance that the interest paid, we have already paid 12. So now, reason here. Of this 20, we have already paid 12. So how much is the balance? The balance is 8. Now, this 8 will go to the balance sheet as part of the current liability. That's what we call the accrued interest. The entire 20 goes to the income statement as expense for the year. Then what's outstanding at the end of the year, 8, becomes the current liability, the accrued interest. Good. Number two, I told that inventory was valued at 259.2 million as at that 1st October 2016. So number 2 is all about the closing inventory. We are told that closing inventory was an amount of 259.2. Now note that whenever you are given the closing stock under the additional information, that means you are not provided with the cost of sale. If you're given the closing stock under additional information, that means you are not given the cost of sales. And how do we get the cost of sale? Cost of sale, it's opening stock plus purchases minus closing stock. Good. So how much was the opening stock? We go to the trial balance. In the trial balance, we have inventory, 1st November 2015 was 226.8. You add the value of the purchases. We have the purchases, 469.2. Then you deduct the closing stock. And here we have the closing stock. In note number 2, I told that the inventory at the end was 259.2. So how much will be our closing stock? I mean the cost of sale. And the cost of sale will be an amount of 436.8. So that's number 2. That whenever you are given the closing stock and additional information, that means you are not given the cost of sale. So you have to compute the cost of sale. And to get the cost of sale, you just take the opening stock plus purchases. You get what you call the goods available for sale. And then you deduct the closing stock. Number 3. On 1st of November 2015, if the year ends on that 1st October 2016, that means the financial year had started on 1st of November 2015. So that means 1st of November 2015 is at the beginning of the year. So you're told that on 1st of November 2015, Peak Limited entered into a 5-year lease agreement for an item of plant. This item had an estimated useful life of 5 years. The annual rental, which is payable in advance with effect from 1st of November 2015, was 132. The fair value of the plant is 552 million, and the implicit interest rate is 10% per annum. So this is IFRS 16 leases. So we have also done the video on that, as because this one is a new IFRS which has been adjusted. Yeah. So there is how we used to present them before, but now it has changed on how you recognize a lease liability as well as on the right to use an asset. And how do we present that? You need to come up with what you call the lease amortization schedule. Now, kindly make sure you have gone through the videos on leases and borrowing, leases and the borrowing cost. So we need to prepare an amortization schedule. And we say that for financial statement presentation purposes, you only prepare for 2 years. Now, we are not accounting for remember the lease period is for 5 years. But whenever you're presenting the published financial statement, because we are only presenting for 1 financial year, you only prepare for 2 years. Then we say that we have the leases which are paid in advance, and we have the one payable in arrears. And like in this case, this one is payable in advance. So now let's read the question again. You're told that. We are in number 3. On 1st of November 2015, Peak Limited entered into a 5-year lease agreement for item of plant. So here we have period, because we are paying in advance. 1, 2, you only prepare for 2 financial year. And then you recognize the balance brought down. Then we are paying in advance. So you start by payment, and that's how you get the balance due. Once you get the balance due, now you can pay the interest based on the balance due, and then you can determine the balance carried down. Now, how do you determine the balance brought down? You see that to determine the balance brought down, so under new IFRS, we see that to determine the liability, you take the present value of the remaining payment. And how to determine the lease liability? Now, this is how you determine the lease liability. At commencement. Lease liability at the commencement, we say that you take the present value of the remaining period. So, we go back to the question. We are told that on 1st November 2015, Peak Limited entered into a 5-year lease agreement for an item of plant. So, the period is 5 years. The item has an estimated useful life for 5 years. Remember that when you are determining the depreciation, you take the lower of the lease period and the economic life of the asset, the lower of. But in this case, the economic life and the lease period were the same. So to get now depreciation, you take the right to use the asset and then you divide by 5. The annual rental, which is payable in advance. So in this case, we are paying in advance. With effect from 1st of November 2015 was 132. So we'll be paying 132. This is what we call annual rental for 5 years. But at the inception, we have already paid 132. So now that means we are remaining with 132 for the next 4 years. The fair value of the plant is 552. So actually, under the new IFRS, you will not now be provided with the 552. You will now work with the lease liability, of which is almost equivalent to that. And the implicit interest rate is 10% per annum. So how do we get the lease liability at the beginning? To get the lease liability at the beginning, you will discount. You will take the lease payment, of which you have to pay 132. The lease period was 5 years. Note that. So if it was for 5 years, but this 132, we paid at the commencement. So that means if you pay at the commencement, now we'll be remaining with the next 4 payments. So that's what now you'll discount. So you take 132 times present value interest factor of an annuity. It's an annuity because we'll be paying each year for the remaining 4 years. The interest rate is 10% for the next 4 years, so it will be 132. We use the formula for those taking FM, they know how to get the formula. It's 1 minus 1 plus R. So it's 1 minus 1 plus R raised power negative N raised power R, sorry. So that's what I'm doing here. So it's 1 minus 1 plus R. R is our interest rate, which is 10, 0.1, raised power negative N for the remaining 4 years. Then you divide by R, 0.1. So it will be 132 multiplied by 3.1699, and you get an amount of 480. That's how you get the lease liability. And therefore, the balance brought down here, it will be 480. Then year 1, payment, it's 0. Because you see, in this case, we have not included the 132 because 132 was paid at the inception. So therefore, that one, before you enter to an agreement, we had already paid 132. So therefore, it's no longer a liability. We have already paid that. So the balance brought down is 418. Payment is 0 because we had already paid at the commencement. That's for the first period. So how much will be the balance due? The balance due will be 418. Then interest at the rate of 10%. So we'll take 10% of the balance due. So 10% of 418 is 41.8, which is approximately 42. Then we get the balance cut down. How do we get the balance cut down? You take the balance due, then you add the interest because this one is a liability. 418, you add the interest, so the balance will be 460. The balance carried down becomes the opening balance, so 460. Payment. Now from the second year, third, fourth, and fifth, now you'll be paying 132, 132. So you pay 132. How much will be the balance due? The balance due will be 328. Then the interest will be based on the balance due. So it's 10% of that 2.8, which will be approximately 33. Now we can get the balance carried down. Balance carried down, you take the balance due, then the interest charged on that is 33. So the amount now will be 361. As simple as that. Then you also recognize an asset. So we say that for lease, operating lease at both the finance lease, you show both an asset as a liability, but an asset you show the right to use the asset. Yeah, right to use the asset. And how do you get the right to use the asset? We say that you take the lease liability. And how much was the lease liability? This was the lease liability at the commencement, 418. Then you add the payment in advance. In case you're paying in advance, you add the payment in advance. Yeah, payment or payment at commencement. You had already paid 132. Also, you say that you add any direct cost in case there was any cost incurred, but in this case, there was no any cost. And if you add, you get 550. Yeah, which is almost equivalent to the fair value that you have been given of 552. Yeah, 550. So this will be the right to use the asset. So therefore, to get depreciation, you will take 550, that's the right to use the asset. You divide by 5 because the lease period was 5 years. So how much will be per annum? 110. It will be 110. Then, now listen here. We also need to show an interest. We also, what do we take to the current liability? What do you take to the current liability? We say that to the income statement, you take 2 elements. One is the depreciation, and this is how we get the depreciation. You take the right to use the asset or the fair value, you divide by the economic level 5. So depreciation per annum is 110. You take that 110 to the income statement. Then also interest. Interest you take for the first year, the year of operating, which is 42. So in short, for what you take to the income statement, you just extract your data from the first year. And then for non-current liability and current liability, we have a lease obligation. We don't own the asset, we have leased. So you have to show a non-current liability and current liability. Now we say that when you are paying in advance, what do you take to the non-current liability? We say that you take the balance due, and the current liability, we say that you take the payment. And in this case, you only focus for the second year. For the income statement, first year. To the balance sheet, you take the second year. Balance due for the second year, the balance due is 328. Then the payment does not change, is 132. And this one you extract from the second year. So kindly make sure you review that video on leases, IFRS 16. Good. So we are through with number 3. So now we can go to number 4. Number 4. Plant is depreciated at the rate of 15% per annum using reducing balance method. Depreciation expense is to be included under cost of sale in the income statement. So all the depreciation, we are told that to be included to the cost of sale to the income statement. So number 4 is depreciation of plant. We are told that plant is depreciated at the rate of 15% per annum on reducing balance. So you take 15%. Now you take the cost of the plant, which is 936, but we're using reducing balance. Reducing balance, that means you depreciate based on the book value. So now, how much was the accumulated depreciation? Now, on the 12 balance, the last item we have accumulated depreciation. On plant was 156. So how much will be the depreciation charge? So the depreciation will be an amount of 117. And we have been told that depreciation should be included under part of the cost of sale. So this one will add it to the cost of sale. Good. Number 5. Land and building were revalued on 1st of November 2015. Now up to that point, that land and building were revalued as at 1st of November 2015. Now when is 1st November 2015? That's at the beginning of the financial year. Revaluation. So we are told about revaluation of land and building. Now whenever you have a revaluation, the motives determine whether we have a revaluation gain or a revaluation loss. And how do you determine whether it gained or there was a loss? You will compare the carrying amount or the net book value against the revalued amount. So now let's go to the top balance. How much was the land? The first item we have land, and the cost of land is 400. Then you also have the building, and the building, the cost is 1200. But remember, building is a depreciable asset. We want to determine the carrying amount or the net book value. Now let's go to the trial balance, the last item. The last item we have accumulated depreciation. So how much is the accumulated depreciation for building? For building, it's an amount of 360. So that means at the date of revaluation, how much was the net book value? So it was 840. Good. I repeat again. When determining a revaluation gain or revaluation loss, you compare the carrying amount or the net book value against the revalued amount. So the cost of the land was 400. Remember, land does not depreciate. Also, you have the building. The building, you are told that the cost is 1200, but there was accumulated depreciation of 360. So that means the net book value was 840. Now you compare that against the revalued amount. So we go back to note number 5. 5 again. And we are told that land and building were revalued on 1st of November 2015 at 600 and 1050 respectively. 600 and 1050 respectively. So how much was the change? Land from 400 to 600, there is a gain by 200 million. Building, there is also a gain of 210. So there is a total gain of 410. And then we say that revaluation changes for PPE and available for sale, they should be recognized under other comprehensive income. So this 410 now will be taken to other comprehensive income. Then note that we devalued the assets at the beginning of the year. If we devalue at the beginning of the year and building is a depreciable item, therefore you need to provide the depreciation charge for the year. Depreciation for building. And since we devalued at the beginning of the year, so you'll take the revalued amount at the beginning of the year, which is now 1050. That's for the building. You divide by, now let's go back to note number 5. That land and building were revalued on 1st of November 2015 at 600 million and 1050 respectively. After revaluation, the building was estimated to have a useful life of 35 years with a nil book value at the end of the economic life. So you'll take the revalued amount of 1050, you divide by the remaining economic life of 35 years. So how much will be the depreciation per annum? And the depreciation per annum will be 30. And remember, we are told that depreciation for our assets we should recognize under cost of sale. Remember, I said that expenses are classified into 4. It's either cost of sale, admin expenses, distribution, or finance cost. They have been told that in note number 4 that depreciation of assets should be classified under cost of sale. Good. We go to number 6. Go to number 6. Number 6, we are told that the corporate tax for the year ended that 1st October 2016 was estimated at 169.8. Yeah, that's the tax expense. And remember I said that tax expense is made up of 2 elements. One, we have the current tax, and then we have the changes in deferred tax. And we are told that number 6, the corporate tax for the year ended that 1st October 2016 was estimated at 169.8. So 169.8. The deferred tax provision as at that 1st October 2016 was increased to 84.6, was increased to. So that means deferred tax, there was an increase. And you see that increase in deferred tax is an expense. A reduction in deferred tax becomes an income. Now let's go to the trial balance. The third last item. So how much was the deferred tax at the beginning? Deferred tax was an amount of 75. But number 6, we are told that deferred tax was increased to 84.6. Yeah, you can read that point again. So that will determine the change or the increase. Yeah, so the opening balance is 75. The closing balance was increased to 84.6. So there is an increment by how much? There was an increment by 9.6. They say that an increase in deferred tax becomes an expense. Therefore, it will increase the tax liability. So therefore, you'll pay a tax of 179.4. Now, this is now what you take it to the income statement as the tax charge for the year. Good. And that's all. That's all about the additional information. Then now, before we present our financial statement, remember I said that expenses are classified into 4. Admin expenses, distribution, and finance, they have not been affected. But the cost of sale, there was some adjustment. Cost of sale. For the cost of sale, we have the balance. Balance brought down. Here it is. Let's be here. Cost of sale, we took the opening stock plus purchase minus closing stock, and we had 436.8. Then you had depreciation. Remember I told that depreciation for the year to be included at the cost of sale. There was this depreciation on lease plant, an amount of 110. plus there was this depreciation on plant, an amount of 117, plus there is this depreciation on building that you take it to the cost of sale. That. And how much will be the total? So let me add for you that one. So 110 plus 117 plus 30, we have 257. Then you add, you get an amount of 693.8. So that's our cost of sales. Then another thing, remember we said that PPE is recognized as a single element to the balance sheet. So PPE to be recognized as a single element. So what do we have to the PPE? We have land, we have building, and you also have the plant. Here is land. Land was, you take the revalued amount. From 400 to 600, you take the revalued amount, which is 600. Then we have the building. Building was revalued to 1050, now you will take 1050. Then you deduct the depreciation charge for the year. And the depreciation for building was an amount of 30. So it will be an amount of 1020. Then we also had the plant. Now let's be here. Plant, the cost was 936 minus, there was accumulated depreciation, an amount of 156. Then you have depreciation charge for the year, an amount of 117. You take the cost, accumulated depreciation, then you raise the depreciation charge for the year, and you get an amount of 663. So in the total will be 2283. Now, under the old IFRS 16 for leases, we used to include also the lease plant here. But under the new IFRS, that IFRS 16, now you only recognize the right to use the asset as a separate item, not under PPE. Good, so that's the working. You can look at for 1 minute before now we present our financial statement. So now let's present let's go to the required. We go to the required. Now required was income statement for PIC Limited in a form suitable for publication for the year ended that 1st October 2016. B is a statement of changes in equity. Then C is a statement of financial position. So I won't wrap this because you already have them in your notes. So kindly you take out your notes so that when you're presenting, you can be able to follow the working so that we can get the right figures here. So, and allow me to wrap this. So I'm hoping now you have opened your notes where you have the workings. So this is PIC Limited. Prepare the statement of comprehensive income. For the year ended 31st of October 2016. So our shillings are in millions. Now we start with the sales or revenue or turnover. Sales, also known as the revenue. And already given, the revenue we have is 1670.4. Then you deduct the cost of sales. And the cost of sales, we have the workings here. It's 693.8. And that's how you get our gross profit. Get the gross profit. Yeah, note that the working carries no marks. So all what we have been doing will carry no marks. Now the marks is now when you post the correct entries. So the gross profit will be an amount of 976.6. Then below the gross profit, you factor in other income. And other income, we had investment income. Just take from the trial balance. There was investment income. Amount of 27. Then you deduct the expenses. You deduct the expenses. Now expenses, we see that expenses are classified into four. It's either the cost of sale, admin, distribution, or finance. So we have admin expenses, distribution expenses, and finance cost. For the admin expenses, there was no adjustment. Admin expenses was an amount of 33. Distribution expenses, no adjustment, so it's 60. Now, for the finance cost, we see that you capture in the interest. And the interest on 8% debenture for the 12 months from the working, that was working number one, was an amount of 20 plus. Under the leases, just check, under the leases, there was interest on lease. The interest on lease was an amount of 42. That was number three, working number three. So the total will be an amount of 62. And now that's how we get the profit before tax. We gave the profit before tax will be an amount of 848.6. That's how we get the profit before tax. Then now we can deduct our tax expense. Now tax expense in our working number 6, let's be here. The tax expense to the income statement, you take 179.4. And that's how you get your profit after tax. And the profit after tax will be an amount of 669.2. So that's the profit after tax. Now, once you get the profit after tax, we see that under profit after tax, you factor in other comprehensive income. And for other comprehensive income, there was a revaluation gain on PPE. Here it is. There was a revaluation gain of 410. You take it to other comprehensive income. So an amount of 410. And that's how you get total comprehensive income. Get the total comprehensive income will be an amount of 1079.2. As simple as that. That's how we present the income statement. Number 2 of the question, you are to present the statement of changes in equity. Now, how do you present the statement of changes in equity? Now, statement of changes in equity will show the items that belong or the wealth of the shareholders. That is, so it will be PEAK Limited, statement of changes in equity, for the year ended 31st of October 2016. Now let's go to the trial balance. What do we have that goes to the equity? What do we have what goes to the equity? So number 1, we have the ordinary share capital. Ordinary share capital. Also, we also do have the retained earnings, as well as there was revaluation. So there is a revaluation reserve. Now that's what go to the statement of changes in equity, the shareholder as well. Ordinary share capital, share premium, retained earnings, and any other reserve. Now preference shares is not part of the statement of changes in equity, because preference share is a debt to the company. It belongs to the preference shareholders. So you start by recognizing the opening balance. That's the balance brought down. Let's go to the trial balance. In the trial balance, how much is the ordinary share capital? It's 900. Retained earnings, we have 717. There was no revaluation reserve. Then you add profit after tax. Now for the profit after tax, it will affect your retained earnings. So profit after tax, not the total comprehensive income, but the profit after tax. And the profit after tax was an amount of 669.2. Then there was revaluation for the year, the revaluation gain. Now revaluation will affect the revaluation reserve. Now what you have to other comprehensive income is what you take to the revaluation reserve, an amount of 410. In case there was any issue of shares, it could have also affected, but in this case there was no issue of share. Another thing that affects is in case there was any payment of dividend. Remember, we paid dividend out of the retained earnings, so you deduct the amount of dividends paid. From the trial balance, I can see there was a dividend paid. And the dividend paid, we pay from the profits. That's from retained earnings. And the dividend paid, I can see, was an amount of 90. And that's how we get the balance carried down. And the balance carried down is what now we'll take it to the statement of financial position. Here we have it's 900. Here we have 410. Here you have an amount of 1296.2. 1296.2. So you can look at that, then we present balance sheet. So now we can present the statement of financial position. So to the statement of financial position, so here is the value of the PPE. So PPE, we have it an amount of 2283. Also, yeah, it's only that we did because I won't have this. Peak Limited, statement of financial position as at 31st of October 2016. Our shillings are remaining. So we start with the assets. The assets we have, the non-current assets. So under the non-current assets, we have PPE, plant, property, and equipment. We take the adjusted one. Remember, I said that PPE should be recognized as a single element, and the amount was 2283. Then we had an investment income, so that means there was an investment somewhere. So let's go to the trial in the trial balance. There was investment. And the value of investment was 540. And the value of investment was 540. Then we leased an asset. Now, since we leased an asset for 5 years, that's what you call a finance lease. We need to capitalize the asset because we are the one using. So the right to use an asset is part of the current asset. So the right to use the asset. And right to use the asset. Now let's go back to the risk amortization schedule. There was right to use the asset. And the right to use the asset, it was an amount of 550 minus there was depreciation charge on this plant, an amount of 110. And you get 440. You take the right to use the asset, then you minus the depreciation of 110. Good. Then, now you can go to the current assets. And the current asset, let's go to note number 2. In note number 2, we have inventory. And we had the closing inventory. Inventory was an amount of 259.2. You're given in note number 2. Then we have trade receivables. How much is the account receivables? Account receivable, you have an amount of 327.2. Also, you can see we have cash in hand. For the cash in hand, we have it an amount of 2. Then we go to equity and liabilities. Now, for the equity and liabilities, under the equity elements, we had the 3 items. You take the adjusted amount, of which we have ordinary share capital. And the ordinary share capital here we have it's 900. Take the balance carry down. We also have the retained earnings. Retained earnings we have 1296.2. Also we have revaluation reserve. Revaluation we have an amount of 410. Good. Now let's recognize the non-current liability. Now to the non-current liability number 1, we have the deferred tax. And deferred tax, you take the balance carry down. Let's go to the last note number 6. To that, the deferred tax was increased too, so you take the balance carry down. And the deferred tax was an amount of, it was increased to 84.6. Then we had 8% debenture. How much was the 8% debenture? Was it 300? The 8% debenture was 300. Also, we have lease obligation. We say that in case you have an asset you have raised, you recognize an asset as well as a liability. For the asset, you show the right to use the asset. But remember, you don't own this asset. You have just raised, so therefore it's liability. And we say that when we are paying in advance, what you take it to the non-current liability, you take the balance due. Look at note number 3. Note number 3, we had the working number 3. And lease obligation is that to the non-current liability, you'll take 328. That was the lease obligation. Then we go to the current liabilities. To the current liabilities, still we also have a lease obligation. Lease obligation is show both the non-current liability, what you are not able to pay within the next one financial year, and then you also show a current obligation, what you're able to pay within the next one financial year. And in this case, you're paying every year 132. So that means the next one financial year you pay 132. Also, we had the current tax. We say that deferred tax is an non-current liability. Current tax is a tax for the year which has not yet been paid. In case it has been paid, it will be shown in the trial balance as a tax paid or the current tax. But in this case, it was just a provision. Let's go to note number 6. Note number 6. How much was the current tax for the year? It was 169.8. In case the amount, there was any other amount in the current in the trial balance, that means is the tax paid. But in case it's under additional information, that means you have made a provision, but we have not yet paid. That's why you have to show a liability. Then, I can also see that we had payables. Account payables. And how much was the account payables? Account payable we have is 202.4. Also, I can see there is bank holding. Bank overdraft. How much is the bank overdraft? For the bank overdraft, we had 20.4. Also, the debenture interest was 20, but we had already paid, that's working number one. We had only paid 12, so there was accrued debenture interest. Accrued debenture interest. It was 20, but they had only paid 12. So there was a balance of 8. And see, the total will be that 8, 51.4. So for the assets will be that 8, 51.4. Yeah, so that's how you prepare the published financial statement. So in our next class, there will be another video. So here we have done one illustration. So I want us to do also another 2 illustrations in our next video, so that also during our Brooks revision, we can do other questions, because this is a topic that does not miss. Meanwhile, that's the end of that session. Thank you for your time.